Let's get Dennis De Silva's take on markets, beginning with tech. What a turnaround. They thought they couldn't push it through with investors.
Yeah, it was interesting. Obviously, they announced it before the market opened, as they should have. And it's hard to believe they couldn't get that support because between Sumitomo and the Kivo family, they're about 45% of the vote. Throw in CIS, which is the Chinese company, there's another 10%. So technically, they needed about 12% out of another 45% to vote to get this 2/3.
I suppose both classes, though, had to approve it separately, as you know.
Yes,
the Class B had to.
But in terms of on an all-in basis, you would have thought it wouldn't. I mean, it was still a tall hurdle. I mean, you're tempted by the Glencore deal, which includes basically we'll pay $8 billion to buy you out of your thermal coal or your metallurgical coal. Then you get 24% of the remaining company, which is the met company. I think I was telling you off air I think at the end of the day, for some people, and I would argue I'm in this camp, I like the re-rating potential as a standalone. I'm going to capture more of that re-rate than if I become 24% of a much bigger company.
You get swallowed up by Glencore, and I mean, they have said they do their own coal separation fairly promptly afterwards.
Yeah, I think part of the hurdle is timelines, and that's probably what they're going to look at. I mean, the sunset clause for the dual share structure, I think, is 6 years. Maybe people would like to see that accelerated. Divesting the metallurgical coal instead of 3 years, which was revised down. Maybe it needs to happen on a more immediate basis, maybe 1 year or 1.5 years. People would like to see this happen quicker so the re-rate could start.
Actually, it's interesting. You mentioned Tech has said, if Glencore's proposal was to go through, it would take about 2 years for all the regulatory stuff to get cleared up. Yeah,
that's part of the hurdle I've had, is just how long it might take, assuming it does go through, versus obviously a made-in-Canada solution would happen immediately.
Do you think, though, Tech goes into the hands of a foreign mining company, the metal mines?
I would hope not. I mean, I think of opportunities lost when it's the Incos and the Falcon Bridges of the world, and you think back to how that could have worked if they were one company and made in Canada. And I think you've seen some of the feedback from the Ross Beatties of the world and the Robert Friedlands of the world in terms of having this made in Canada solution. It'd be a shame to kind of lose our champion again.
Let's talk about uranium. We have an email from Jeff. Jeff is asking, would you take NextGen or Cameco? Do you see NextGen, for example, doing well over the next 20 years? Or should I stick to a major like Cameco? Because NextGen's not a miner yet. They're working on their project.
Two very different beasts, obviously, in the same industry, uranium. But NextGen is an advanced stage development company. Arguably, the next project that gets built in Canada probably will be NextGen's, versus Cameco is obviously the granddaddy of uranium, and they go across the spectrum of traditional mining to ISL mining in Kazakhstan and the US and so forth. So very different risk profile. You'd buy a NextGen if you're looking for the re-rate, but with a re-rate comes all the risk associated with it. That's why it's called re-rate. So, getting it fully financed, which I don't think is an issue, and then execution, building it and bringing it on and hoping it all works according to plan. We know that track record in general for the mining industry is not great. Things never go according to plan. It always costs more and it always takes longer. Versus Cameco, if your ultimate goal is how do I get exposure to uranium, which right now is going through a renaissance, I'd say Cameco is your best way to do that.
Right. So I'm just trying to remind myself, NextGen would like to be mining in Saskatchewan. I think their Rook 1 project is their lead one.
It is.
Yeah.
And that would be, hopefully by the end of this decade would be the goal, because obviously things don't happen quickly when it comes to uranium mining. It's not an ISL project which has a shorter time frame. This would be traditional mining like Cameco would do. But it's a great project, and I think they've been well rewarded for their success. But it's a very different risk profile in terms of getting to that point, as well as what gives you best leverage. Of course, exploration companies often can give you the best leverage to uranium. But if you're just looking for a little bit of a dividend, not much in Cameco, and you want the predictability and still get real upside from today's prices going up, then Cameco is certainly the way to do that.
Yeah, so Rook 1, and then the Arrow deposit seems to be the flagship piece of that property. Shiraz has sent us an email, wants to know about Ivanhoe. Do you like Ivanhoe mines at the current price?
You know, I was talking about it off air in terms of it's often considered a takeout candidate. It is building, arguably, in the DRC, Democratic Republic of Congo, the fourth largest copper complex in the world, and they expect to be there by 2025. Obviously founded, and the co-chairman is the famed Robert Friedland. I think the issue for us with this stock has always been it's in the Congo. And that obviously brings great controversy. Obviously, Mr. Friedland has great success in operating in what I'll call fringe areas, no different than the Lundin family and companies like that.
Yeah.
I think the issue here really is just geopolitical risk. You see that in the discount on the stock compared to its peers. But I have no doubt probably a major, you could argue a Glencore or Rio Tinto or somebody who wants to enhance their copper exposure for the upcoming energy transition that's coming on, they could look at something like Ivanhoe and get past that geopolitical risk because of their size.
Are we in a situation where miners are saying much easier to take over other companies and just own their mines rather than trying to build our own project?
You know, you look at a Teck, you look at Ivanhoe, you look at a First Quantum, you know, you could buy it and you kind of know what you're getting. It's producing.
You hope. Yeah, sometimes,
hope.
yeah.
Compared to the execution risk and the immediacy of trying to get production. I mean, I told you, Cobre Panama and QB2 from Teck, I mean, those are the last couple of major new copper projects. And there's nothing envisioned really outside of expansions over the next few years. So how do you get that lift? How do you really capitalize on this market over the next decade?
Yes.
And it seems easier to buy. Even Hudbay's in it with buying Copper Mountain, much smaller. But the idea is, how do I get scale?
Speaking of which, let's go to John in Toronto. Go ahead, John.
Oh, and Dennis, thanks very much for helping us out. Dennis, I was a long time, it's funny you just commented on it, but I'm a long time holder of Copper Mountain. I had a target of $4, and Hudbay came in and picked it up at $2.67. Copper Mountain is a 30-year mine life and improving grades. But I've never followed Hudbay as a miner. It has big operations in Arizona, but it's also in Peru, which can be unpredictable. So my question, Dennis, is Hudbay a buy, sell, or hold in your analysis? And what copper do you hold? And Dennis, I know I'm stretching myself here, but I've never experienced this where a bigger company takes over a smaller company. And I guess if you want to answer it, I would appreciate it. Does the smaller company shares just get converted over to the bigger company, generally speaking, or do I have to make a move? And thanks again, Dennis, for your help so much.
It's a good question. The last thing your broker should just do, it should get dealt with you automatically in a stock swap, shouldn't it?
It would be automatically assumed. Obviously, it's approved by shareholders. It automatically just shows up in your account. Sometimes, depending on the complication of the deal, in this case, it's pretty simple with Hudbay and Copper Mountain. You may have to make an election for tax purposes sometimes. But in this case, I'm pretty sure it's automatic, and it would be a tax-free. But always talk to your broker.
Take advice. Yeah.
In terms of, you're not wrong, John, in terms of the experience, often going from a junior, which is a very different risk profile, in this case, Copper Mountain, a single producing mine, and all the good and the bad associated with that. A little more leveraged in terms of the balance sheet and the operating costs for the company. So it gets integrated now. It adds some immediate production for Hudbay. Hudbay, at the end of the day, its future is predicated on, you mentioned it, Arizona, and I think it's called Copper World, interesting name, which they acquired several years ago, and it's been mired in, bureaucracy and trying to get this thing permitted so that they could try and build it. I think the last time I looked, it's like a $2 billion project, so very material relative to their market cap. I'm always concerned about those situations when the amount of development, NAV, is a very high percentage of your overall value. There's that elevated risk of execution becomes more acute in those situations. So we don't own Hudbay. I haven't owned it for years. I've always kind of preferred Teck or First Quantum, companies like that, who are kind of past that hump, and now you're really reaping the rewards of free cash flow.
Let's head to Chilliwack, BC. Here's Frida. Go ahead, please.
I'm interested in your comments on the news of Cenovus today, plus any comments on Tamarack Valley or Baytex or even Athabasca Oil, if possible. Thanks for your help. Bye-bye.
Got a bit of a laundry list there. Do one or two if you would,
Sure.
Dennis.
I mean, Cenovus, I think at the beginning of the show, we talked about them reporting and missing on cash flow and production. It's a bit disappointing because fourth quarter was also a disappointment where they missed. And then there was a reduction in expectations and even delaying hitting their debt target into, I think, at least the second half of this year. So it was a shame to see Q1 weak again. I think some of it was telegraphed. And you can kind of see by the market reaction a bit indifferent to it. But still, I'm looking forward to an improvement in deliverability and consistency. You have the new CEO who really was the COO, so not new people, but certainly a change at the top. It's a company we don't currently own across all our portfolios. We have it in some selective portfolios, and I'm looking for a good entry point. I think right now it's a little bit in the penalty box with some of these changes and misses, and I've just chosen to invest in other companies. Unfortunately, none of the ones that are on your list. I was going to say Tamarack is probably the second best of my choice there, and they're kind of working through debt right now after a bit of an acquisition binge over the last couple of years. So I'm looking for a return to higher shareholder capital returns. Right now they're at 25% of free cash flow. I'm looking for it to kind of increase to 75%, hopefully by the end of this year, and then it looks more interesting.
And what is the problem at Cenovus? Is it possible to...
You know, I think it's a complicated beast. Obviously, there's been a cleanup with the company from after M&A, and I think it's a little bit more of the indigestion and getting Husky fully integrated. Probably, I'd say by the second half of the year will look more interesting.
Okay, Dennis De Silva is taking your questions today on resource stocks. Michael's on the line from Vancouver. Go ahead, please.
Thanks, Andrew. Thanks, Dennis, for taking my call. Dennis, my question is on Agnico Eagle. Dennis, basically gold at this point in time is at close to an all-time high. Agnico, several times, it's been in the 110 to 115 range, and it's now been mired between $70 and $80 for quite some time, it seems to me. I'm wondering whether you have any sort of answers as to why the price difference between the gold price and the stock price, and do you like it? Do you recommend it? And maybe you can explain that discrepancy to me.
Sure.
Thanks so much, fellas. Have a great day. Thanks for hanging up and listening to your response.
Thank you.
Good question. You know, I can't say Agnico is unique in terms of a little bit of divergence between stock price, which you would associate a company having leverage to the underlying commodity, versus what gold has done. I've always explained it to clients this way from a broad perspective. Inflows always start usually with ETFs around gold. As it gets a little deeper, it then flows into senior producers like the Agnicos, like the Barricks, the Newmonts, and so forth. And then if it gets deep enough, there's enough interest, retail interest increases and forth, then it eventually moves into intermediates and junior producers and even into the exploration stage. As it starts to mature, you start to see the exploration names really outperform because that's kind of the last flight of capital. So Agnico, I'd say right now, a little bit of a tougher 2022. I'm looking forward to better things in 23. So I think there's a little bit of overhang from that. It's a company that just digested, you know, they own the two largest gold mines in Canada now between Detour and Malartic, and that was through that Pan American Yamana deal. So they consolidated Malartic. A little bit of indigestion again, even though they are the 50% partner originally, just integrating everything, coming out with new plans now that they run the whole show. A lot of moving parts, obviously, with their Northern Canada core assets, also Amaruq and things like that. So I think right now I don't own it. I'm looking for, again, an entry point. I do think there's legs to this gold trade. I think the preference is to go through some torquier names, debt-free names. One of them I'll talk about later on is kind of my preference at this point.
Okay, we have an email from Jones. What's the outlook for oil prices?
You know, right now we're around $76 US for WTI. Our expectation is $80 is probably a fundamental floor. A lot of it is predicated, obviously, on OPEC showing this willingness to work hard to create that floor. I think they caught the market off guard with how quickly they came back with another cut. You look at China reopening, there's question marks about the velocity of that reopening. Some people say it's disappointing. Some say, okay, it's on track. It's better than where it was a year ago. I think that's still a fine-tuning issue in terms of on the demand side. Where's the recession? When? How deep? How long? That all is creating a bit of an overhang on oil in terms of how high it can go. But I'm comfortable with $80. Companies certainly aren't using that price, and I can't say they're valued at $80 oil. They're probably more in that $65 range. So I think there's material upside in the right companies. The key is stay still defensive, own companies with dividends, I would say, clean balance sheets, and that are I think have shown this willingness to stay on this path of return of capital to shareholders.
In Western nations, I know there's complex policy within policy here and agendas we have no idea of, but the Western nations wanted Russian oil to keep coming on the world market, but at a lower price for Putin. And it seems to be working in the sense that Russian oil is still being exported.
Look, it's a very complex mechanism, and what it just means is that you displace oil. So whether it's the Chinese or the Indians, they will source it from Russia, and we've seen those statistics, and they displace other sources who will then go into other markets. So the oil will find its way. You're not going to probably be able to lock them into $60 oil prices, but it will certainly not be the world market that they're getting.
Dennis was on our show July 13th of last year. ARC Resources, the gas producer, was your first idea. Natural gas prices have suffered, but this went up over the period.
Yeah, it's one of our top ideas when it comes to gas, and I will admit, I think this is the time when you're buying gas names. It's easy to say you're being a contrarian, but ARC is one of those cream of the crop names. We put them up there with Tourmaline is obviously our favorite. They've done a good job of getting egress, that is getting other markets. Unfortunately, the one they did with Cheniere, I think, only starts in 2029 or something like that. So you've got a ways to wait before they could ship offshore through LNG.
Oh, nice. And would that go out through Texas or Louisiana?
That would go through the Gulf, yeah.
Okay, yeah.
And then obviously we're all waiting for LNG Canada to come on stream 25 or 26 and see who kind of lines up there. I'm going to guess companies like Tourmaline and ARC are kind of first to the trough in terms of who you want to contract your gas with.
So you'd stick with ARC anyway?
Yeah, we continue to own it. It's one of our favorite ideas in the gas space.
Whitecap Resources, wow, up more than 30% over the period.
Yeah, Whitecap, on the flip side, this is an oil name, and similar to Tamarack, as I said earlier, a bit of an acquisition binge. So right now they are expected to kind of hit their debt target from the big XTO acquisition last year, which really filled in the gap for inventory. I shouldn't say fill in, but really accentuated their inventory story with respect to things like Montney and Duvernay. So I think that target gets hit probably by July. They've kind of guided us to seeing a dividend increase, where we'll get a pretty nice bump. I think we'll probably go to a 7% yield at that point. So debt is being very managed well. A 7% yield is quite attractive. I think their M&A is kind of done now, and it's really about harvesting free cash flow. I saw their durability on the dividend is down to like $50 US per barrel. They can maintain their production at being flat and pay that 7% enhanced yield. So those are the things that attract us to a name like that. And they have the interesting twist of their carbon capture business, both in Alberta and the one they're going to build in Saskatchewan. So a few nice things.
That's interesting. So they've said the dividend, they can cover that right down to $50 WTI.
Yeah, definitely. And that maintains production flat at this point.
CF Industries, big nitrogen fertilizer producer. The fertilizer stocks have been under pressure.
Yeah, this is what I would call mid-cycle right now. We obviously went through the peak in mid-2022 with the fertilizer stocks. Obviously, I talked about the stock close to that peak. The expectation was you wouldn't see kind of the buyer strike that we have seen from farmers. So what drives this stock is, I think it's pricing less than $325 a ton for nitrogen. Right now, nitrogen is around $400 in North America. So it's deeply discounted. I think it could be $110 to $115 US. Farmer economics are as good as they've ever been. I think 2022 was the highest in 50 years. We won't quite be there this year, but I think we'll be in that top 2 or 3 in the last 50 years. And you will see a return to using nitrogen. It is kind of the most crucial of the 3, phosphate and potassium being the other ones. And so I do see that recovery, and we're seeing it in the U.S. right now. So I do expect momentum in CF building, especially when you consider marginal producers like Europe. Their cost of supply is around $500 a ton.
Right. Although I suppose the European ones have been bailed out by a drop in the natural gas price.
They have, and our view is we're kind of near that trough for gas prices. You could debate what inventory levels will be next winter, but our expectation is it can't be worse than it is. It's full. It won't get more full. So we think there will be higher prices, which will drive the cost of supply for those marginal producers higher, and then CF kind of fills that gap.
We'll take a break. Dennis De Silva, Senior Portfolio Manager at Middlefield Capital, is taking your questions on resource stocks. Robert is standing by in Ottawa. Fire ahead, Robert, please.
Hi, Dennis. How are you today?
Excellent, thanks.
Good. I was watching Sherrod International in the last 4 years hasn't received any coverage on BNN, and after all, the 50% bond caught 3 or 4 years ago. Clearwater Capital had just bought it at 10.5 registered stake this quarter, and the company had bought back $150 million of the bonds last year. What is your view on Sherrod's nickel and cobalt future today?
Okay. And the pretty small market cap these days, only about 200 million, Dennis, sorry.
Yeah, pretty small. I mean, they hit their heyday, obviously, when they had that Madagascar mine, which they eventually just got diluted out of because they couldn't keep up with cash calls. And now they're basically almost exclusively a Cuba producer of nickel and cobalt and refining in Saskatchewan. I haven't owned this stock in a long, long time. Always a high leverage stock in terms of risk reward. You know, again, the Cuba issue for me, do I want to own something that is exposed to that geopolitical risk, although not as bad as it used to be? It's just been a name because of its market cap. It doesn't offer anything that we're looking for. There's no dividends. The debt is obviously a very different beast than it was 4 or 5 years ago. But I just don't see anything compelling in terms of, okay, what are my nickel or cobalt options? I can think of plenty of other names that give me better risk-reward situations.
David is standing by in Niagara. Go ahead, please.
I just want to get Dennis's opinion on Victoria Gold. If it's a buy or a hold at this time and moving forward. Thank you very much.
Thanks. Can you remind us where they're active, please, Dennis?
They're in northern Canada, and they have one of the latest big new mines in Canada. It's, like I alluded to earlier, kind of 90% of the time it doesn't work according to plan. It takes longer, costs more, and ramps up a lot slower. And I would say they fall victim to that, and they're not new to it. I think the last quarter wasn't too bad in terms of meeting expectations, but still in the penalty box in terms of let's see more consistency out of the operations. Again, not an unusual situation to be in. That's why we kind of avoid companies as they kind of start building something, and we only kind of get into it once we see a more stable operation. You might miss that initial 20 or 30% re-rate, but for us it comes down to reliability, and we want to see consistency and then bolt on other mines. In this case, it's a single mine operator, so you have that inherent risk also. You can't run and hide anywhere else in terms of other operations that can make up the slack when one mine isn't working well.
Kareem is in Ajax, Ontario. Go ahead, Kareem. Sorry, I think I skipped over you earlier. Go ahead, please.
Hi, thank you for taking my call, gentlemen. I have a question on investing between two companies, either MAG Energy or Athabasca Oil. I'd like to get your opinions on both, if possible, please. Thank you.
Interesting, because they're both seen as a leverage play on heavy oil.
Definitely. So I can't use my leverage argument. I don't own either one, so I'll start with that. Our preference has been to stick primarily to light oil, although one of my picks will be a heavy oil producer, but not the same type of heavy oil where it's not steam assisted. It's more conventional, and we could talk about that later. But if I had to pick between the two, I would go with the one with MEG, larger market cap, better ownership in terms of the institutional ownership, better liquidity. Athabasca is a little more focused on still some level of debt reduction. They prefer buybacks. I kind of am preferential more to dividends than buybacks if I was looking for income. And you could kind of see the rocky performance of the stock. Again, no surprise, leverage to oil. But I would say stick to the liquidity of something like a MEG.
Oh, okay, that's interesting. Because I guess, when the market goes very negative, a less liquid stock can drop further?
Yes, obviously liquidity could be an issue. I don't think Athabasca is that illiquid.
No,
but if you're thinking of, the best way to get in and out and also liquidity flows, I'd prefer to look at a MEG just from that perspective.
Right. Rakesh is in Edmonton. Go ahead, Rakesh, please.
Oh, good morning, Andy and Dennis.
Hey.
My question is on Nutrien, NTR. It's going down a bit. Is it a good entry point around $94, $95?
Thank you.
Yeah, Nutrien, obviously the granddaddy of fertilizers, and it's about 40% potash, 30% nitrogen, and 30% what I'll call retail operations. The retail has always been nice because it's that balancer in terms of a little less susceptibility to direct fertilizer prices like you would with the CF and other fertilizer companies. It's obviously had a tough run. It's come off that peak like all fertilizer companies did in mid-2022. If you look at an 8 times multiple, and I'll call that a mid-cycle multiple, and you were to use today's prices, not what the market's pricing in, I think you could easily see the stock kind of in that 120 to 125 range, just using normal mid-cycle multiples, no expansion. Because right now, I think I said earlier with CF, you're using less than $325 US a ton. I think for Brazilian potash, which is a good benchmark, you're using less than $350. And we know both of those are closer to $400 or $430 a ton. So plenty of upside just on a more normalized price environment, which is still elevated. I'm not saying we're going back to where we were 5 years ago, but the world has changed. Obviously, the Ukraine war is a big part. You see volatility of weather all playing a role. Strong farmer incomes should see a return to usage that we didn't see in 22. Again, that buyer's strike. And I think that's where you'll see Nutrien looks very interesting right now. We have been adding to it in our agriculture fund, for example.
Paul is calling from Squamish, BC. Go ahead, Paul, please.
Good morning. My question is on Capstone Copper. I was wondering if you could give me your thoughts on that. I appreciate that. Thank you.
Thank you.
Capstone, we talked earlier, again, the whole saga with Teck, and we talked a bit about Ivanhoe. I would put Capstone kind of in that kind of scenario of a good takeout target. It's a pure play, went through a bit of a transformation a few years ago when it merged with a private company, kind of took their mines from 2 to 4 and really scaled it up in terms of size. Cost structures come down. It's better than average, but I wouldn't call it top tier at this point. Pretty good balance sheet. I think this is one of those interesting leverage plays on copper. I've been buying it in the last month because I do think, again, with China reopening and the need for copper and the lack of real game-changing projects coming into the market, names like Capstone, because of a little bit of the balance sheet, a little bit of the higher operating costs, you get real leverage to better copper prices.
Gulam is calling from Toronto. Go ahead, please.
Hi, gentlemen. My question was on 2 gold stocks that I owned for quite a while, not making any money on it. It's Eldorado Gold and Kinross. And I was thinking of adding to my position. Do you think it's a good time to get in?
Kinross and or Eldorado?
I don't own either one, but I mean, they both have hair. I mean, Kinross, obviously, a little bit of history issues, trying to right that ship, doing better more recently. Eldorado, it's always been about, I said earlier in the show, how much of your net asset value is exposed to development risk. And they're very high. I think it's around 60%. They resolved a lot of the grease issues with their new mines, so everything is getting permitted and built. but there's still execution risk. Building it, it's financed, but building it and hoping everything works according to plan does expose you to that elevated level of risk. It's not like you've priced that in. The stock does trade at a discount because of that geo risk to some degree and execution risk. So I've kind of stayed away from both. I've always kind of stuck to the cream of the crop. I've had a preference for Agnico, which we talked about earlier. That's kind of where I prefer to go. And I think it trades at a similar valuation to its peers. And I don't think that's deserved. I know they've been in the penalty box a bit since 22, but it still is one of the best teams and one of the best executions I've seen over the last decade.
And Agnico is now way up there among the giant global producers in terms of output.
It is, and obviously we'll have to see what happens with Newmont and Newcrest in terms of how that shakes the tree, and they'll obviously still be the biggest, but even more substantially. But, you know, Agnico is one of the premier companies globally. They've really put their stamp on being a Canadian company now with the consolidation of Malartic. I think it's 80% of their asset values in Canada.
Oh, that's interesting, yeah. And that's going to attract a lot of people.
Look, I'd be surprised, but we've seen significant consolidation at the top. You know, if Newmont wanted to get bigger, do they look at something like Agnico? If they fail with Newcrest, which is an Australian company, they might look at Agnico.
Okay. Apparently they want Newcrest partly because Newcrest is copper, and Newmont's very keen on copper.
And we've seen Barrick talk a lot about getting copper as part of their portfolio. I think the goal is around 20% because, again, everyone sees the duality of having that. You know, Franco-Nevada might argue they are always careful to keep their non-gold exposure to no more than 20%. But we're in a new dynamic in terms of energy transition and people looking at critical minerals and whether they want it in the portfolio.
We have an email from Richard. We're tight for time. Do you believe Pipestone Energy will get back to $6?
I don't own Pipestone. It's a company I got. I think it's been around 10 years. It's a gas producer. Right now, obviously, it's suffering because of weak gas prices. Unlike a Tourmaline or an ARC that has this great marketing and being able to get egress to get out of Canada and not be stuck with AECO or Northern BC prices, Pipestone doesn't have the advantage of that kind of marketing power. So I don't own it. It doesn't offer the same sort of yield like some of the names that I own and the same type of balance sheet protection that I'd prefer to have.
I'm showing a yield of about 4.7% on Pipestone right now.
Yeah, I think the names that we typically own are more in that 6-7% range, and I think there's durability to that kind of yield at this point.
First idea is Headwater Exploration, HWX of the TSX. Can you remind us what they're all about, Dennis?
Yeah, if I had to pick a theme between my three picks, it's no leverage, nice yield, and ability to grow cash. And even grow. In this case, Headwater is a mid-cap. I think it's about a $750 million market cap oil producer. In the heavy oil side, they're in the hottest play probably in Canada, the Clearwater Formation, which is a heavy oil formation. What can I say about them? So 6% yield. They are growing 40% their production this year and anticipated to grow 25% next year. And they have $100 million of cash, and that will probably grow in the next couple of years to where cash could be 20 to 25% of their market cap. So I can't think of anything better than a clean balance sheet, the ability to tuck in more land acquisitions to build your inventory. In this case, I think they have more than 10 years of drilling inventory in one of the hottest plays in Canada. Very strong free cash flow, and they understand the need to have shareholder returns, so a nice 6% yield that I think can grow quite easily in that 8 or 9% range, even if the stock price didn't go up.
Okay, we've got B2 Gold, Clive Johnson's company, of course, the core of its operations in West Africa, but they made a move into Canada's north with the acquisition of Sabina.
Yeah, this is a 1 million ounce producer. As you said, production in West Africa, and I have been accumulating it over the last several months. I've owned Sabina also, so I tendered that in. I was quite happy to see that deal. So they enter into Nunavut, so a new territory for them. But these guys have built in Russia. The Kupol mine is nothing new. So they have the experience, and I think they can even improve the economics of that Back River mine that is being built. It's an unusual acquisition. Usually they don't buy in the middle of something getting built. They tend to buy before so they can look at their own financing arrangements, or they buy it when it's done and all the kinks are out of it and they can have an operation that is nice and smooth and be a positive for the overall company. So this one, I do like the name. I think it's a 4.5 or 4% yield. No debt again, very important. And Sabina's Back River mine really does offset decline from another mine that shuts down in 2025. So it allows them to kind of stay flat at 1 million ounces.
And then your final idea is Trican Well Service, TCW, leverage play on oil prices?
Yeah, I mean, this one probably really low on the radar screen for a lot of people, but very well covered by the Canadian banks. And this is a company, again, no debt. They have a nice yield. I think it's 6 or 7%. And the fact is they trade at a 2.5 times EBITDA multiple. Historically, let's call it the last 10 years, it's been a 5 times multiple. I understand they've gone through the trough, you know, where services were down, but now we're seeing that pick up. They particularly are advantaged on the gas side. They are probably the purest frac play that you could see publicly listed in Canada, and they'll benefit from things like Northeast BC, where First Nations issues have been resolved in that Blueberry area. Obviously, LNG Canada coming on. That probably means a 10% pickup for their rig activity as that comes on in 25 and 26. So dividend, ultra clean balance sheet, so they can weather any near-term storms like weak gas prices that we experience right now.
That's interesting. So they've really tamed their debt load?
They really have. I mean, you could say that about the energy sector in general in Canada. They've all focused on cleaning up the balance sheet and then pivoting into return of capital. Again, it's an overused term, but I think it's very crucial to maintain that balance between how do I run my business, moderate growth, but return capital to shareholders so they can see the true value of the business they've created.
Is this a theme across the resource sector? People just keeping their production growth modest so that they can get cash back to investors?
Well, I'd say in the energy patch, that's certainly been the case the last few years. I'd say they heard shareholders, you know, after a 5 or 6 year span where it was growth at any cost, especially I'd say in the US, not so much in Canada. You've seen this mantra become the norm, and you've seen the stock reactions. I think they've been rewarded for it. So how do executives get compensated? In the past, it was absolute growth. Now it really is about meeting other criteria like return of capital to shareholders, generating free cash flow. And as long as you can orient their compensation and get rewarded for that activity, which we've seen in the last 3 or 4 years, that's how the companies will behave. And the stock prices have reflected that.
I suppose there is a built-in conflict with takeovers. A CEO is going to expect more money if he or she is running a bigger company. But me as an individual equity holder, I may not do that well with a takeover if they push one through.
Well, especially if you have change in control parameters where company CEOs might get paid 2 times their overall compensation for the last 3 or 4 years if there is that change. And yes, they can benefit from running a larger company if they are the survivor CEO in that situation.
Yeah, it's interesting because I think evidence shows that takeovers often don't enrich shareholders.
It really depends what you're referring to. You know, I've been talking about the Teck Glencore deal, and for me, I don't see the same upside outside of, yes, exiting my metallurgical coal right now because they will give me that cash option.
Yes.
But at the end of the day, I want to get the full re-rate, not 24% of it.
No, that's right. And there's apparently so many people sniffing around Teck's copper mines at this stage.
They are in the driver's seat in terms of attractiveness, and it's just who's going to pay the right price if you could get the Keevil family really on board, and the Sumitomo group also, which will vote, I think, in line with whatever the Keevils want.